Hello, everyone. Welcome back to Company Founding 101 Class 6. And I'm George, and like always, and this is sponsored by Sun Endowment. Today, we're going to talk about cost and budgeting. These are important things for your company before planning something. So, when we talk about cost, we need to talk about different types of costs. So, there are direct costs and indirect costs. So, direct cost means like let's say I am running a car factory and this is directly tied to my car production. Let's say the production of iron is the type of cost that I have to pay. There's a direct cost. And the indirect cost is from multiple cost objectives and not traced to my product, to my car. For example, like the people I hire to manage my car companies. And let's say my factory, I rented it out. The office rent is an indirect cost. There are some fixed costs, variable costs, and opportunity costs. I think a lot of us didn't learn microeconomics, and these three concepts are extremely important that's being covered in there. And I just think it would be beneficial to know. The fixed cost means if a company doesn't produce anything, like if my company stop producing cars, I still have to pay the rent, let's say. So those are the fixed costs, which is unavoidable in short terms. And variable cost means the cost that's vary based on our production. For example, when I'm producing 10 cars instead of 20 cars, I'm spending less. So that means my variable cost is lower. And there are opportunity costs. Opportunity cost means I am giving up the second best option for the first option. And that second best option that I gave up is the opportunity cost. So these three things made up, I mean, these five things made up of our costs for making these decisions. And so now we talk about cost accounting techniques. So job order costing, what does it mean? So of course you guys can read the PowerPoint. It means I do accounting based on job. So what does this job incur? For example, what does building a car, like car builders incur the cost? What does the manager incur the cost? So I do it by that. Or I can do process costing. So this is mostly used in, let's say, manufacturing companies because let's say, washing the car costs like this much amount of money, iron down the iron costs this amount of money. So this is another way for accounting. And activity-based costing, which means each activity is basically taken into account. So let's say today I went to business travel and for deal, and that will just be in the travel category of a costing. So now we have to look at cost volume analysis. It helps us to determine how changes in cost and volume affects a company's operating income and net income. So we have to look at this to make decisions in budgeting and forecasting models. So since we know the fixed cost is always consistent, so it is just a straight line. And as we can see here, there are two shaded areas. One is blue and one is red. So the green bolded line is the sales, and the thing that ranges from like I don't know what color is it is yeah it's like darker green is the total cost. So as we can see here, when those two lines overlaps with each other, that's the break even point, which means oh, I'm breaking even, as in I'm not making any money, but I'm not losing any money either. But before that, in the red area, it means we are losing money. And in the blue area, it means we are earning money. So the break-even analysis involves calculating a point at which revenue is received equal to the cost associated to the revenue. And this is in a more simpler graph. As we can see here, it's probably like the 500 and 5,000 is the break-even point because the total cost and the level of sales intersect with each other. And that's the most efficient point of production. You want, because when we produce more, the cost goes less, but we can't sell as much. That connects to supply and demand graph. And in the break-even point is the most efficient. Now we're going to talk about budgeting techniques. So we have to talk about incremental budgeting, zero-based budgeting, and activity-based budgeting. So incremental budgeting means, oh, let's say my 2021 budgeting was $100,000. Since now this is a new period, I want to increase that to the new budget periods. Let's say increase $10,000 each year. Zero-based budgeting means every function is analyzed for its needs and cost. And this is extremely time consuming because every single thing is being analyzed. For example, I'm going on a travel. I'm going to tell you, oh, does this make sense? If it does, we're going to have to budget that way. So it's built around what is needed. So sometimes we might need more, we might need less. It doesn't matter than the previous term. And this was, I don't know, to me, this is the most serious, like the most time consuming, obviously, but I don't think I would use this for my own company. And activity-based budgeting involves creating a budget based from activities that for companies to achieve its potential. And I really like this one because the activity base shows that if I do XYZ things, my budget is sufficient. I won't require more budget unlike the first one because I don't know how much money I'm going to need if I'm starting a new sector. So these are basically the basics. Of course, go in more detail, and I will give out the second course explaining go in detail of economic terms, so which these things will be covered in more depth in one lesson specifically. For example, um, the graph, let's say fixed cost. We'll talk about that for a whole class. So believe you can be successful, and thank you so much for listening. And email me if you have great ideas for potential partnerships. So see you in the next class.